I'll show you how to use Bybit Earn, which lets us earn yield on various different crypto assets like Bitcoin, stablecoins, ETH, some other altcoins. There's a few different things going on under the surface, which I will explain in this video, how it works, some of the risk, and if you want to do that. So basically, there's three ways to do this. One is lending. So you lend your asset out, someone pays you an interest for that. There's staking, which is where you stake a crypto asset on the blockchain and you receive a percentage of the fees paid on that blockchain and the staking rewards as well if there's any inflation. So you get some yield back from the blockchain there. So that's not lending, you're just staking on the blockchain and receiving a portion of fees and token inflation. The third one is wealth management, which Bybit actually carries out this fairly simple arbitrage between their spot and futures markets. And so you put the money in and they carry that out for you. I'll explain all of those in this video. Let's start with Bybit Savings, which is essentially lending. So you have an asset, you put it on Bybit and you lend it to someone. They borrow it from you and they pay you an interest for that. And then at the end of the term, they return the asset back. That's how it should work anyway. And Bybit sit in the middle. So if you don't have a Bybit account yet, click the link below in the description. And then when you make a deposit, you can get up to $30,000 as a deposit bonus to trade with. Super good. It's one of the best in the industry. So if you don't have an account yet, check that out. They also run other offers for the Earn platform and some of the other products as well throughout the year. So definitely worth checking out. But from here, if you do have an account, you go to Finance and then Earn. And then down here, you can see which assets you can actually use in savings. So I'll check for Bitcoin here. Flexible savings is available. So that means flexible. The interest rate and the time horizon are both flexible, which means you can put assets in and then take them out whenever you want. If there's a fixed term, let's say that's 30, 60, 90 days. As you can see, wealth management has a fixed term of 30 days. You have to tie that money up for 30 days and you can't take it out. Now, there may be some of these products where you can take it out early, but you forfeit the interest as well. So you'll have to figure out exactly, but I'll show you here, flexible savings and the interest rate, the APR is 2.5%. That means that the annual rate is 2.5. So if you only have it in there for a month, you're not going to earn 2.5%. It's 2.5% as an annual rate. And then obviously you have to figure out how much you could make on your stack if you only invest for a month or a week or something like that. So let's go ahead and press buy now and we can figure this out. So this is BTC, this is the APR, flexible, stake now, and then we'll put an amount in like this. And we can see that we're in this bracket right here. So we get 2.5%. And you can see that the daily yield that you make, you can put auto savings on as well, which is where if you do have any Bitcoin in your account, it just automatically goes over to the savings and it's gonna be lent out on the platform. Flexible, so you can bring it back whenever you want. You have to agree to the terms and conditions. And then you can see up here the stake date. This is when the yield starts and the yield accrual time, etc. So that's your distribution time as well. So that's flexible savings. So you can go ahead, press stake now, and that will stake and go into your flexible savings. Now from there, because this is flexible, you can just go into your flexible savings and take it out as well if you need to. If you have the Bybit card and maybe you have some stable coins to pay for things with the Bybit card, then you can put those stable coins in flexible savings as well. And they're actually spent, when you spend on the card, they're spent out of flexible savings. So as an example, I do this with USDC. I've got some in there on the card. We can go to flexible savings. Current yield is 9.8% for under $500. Above $500 is 4.81%. So press buy now. And I've got flexible savings turned on actually, but we'll press stake now here. And you can see that I've already got auto savings turned on. So any USDC in my account, that just goes over to flexible savings. And then if I spend on the Bybit card, which I have, it just comes out of flexible savings immediately. So if you've got some in there, maybe I've got some amount in here now. So that's gonna just go straight over flexible savings. That goes once a day auto into flexible savings for me. And you can see the real APR changes over time. Remember, this is flexible. So the interest rate can go up or down depending on the demand for borrowing from other people that want to borrow and that pay an interest. So you can see this is flexible over time, but I use this for USDC where I just put some in there to spend on the card. And if I'm going to spend it on the card anyway, then I may have it in flexible savings and it just comes straight out of flexible savings. There's really two main risks of doing this on a centralized platform. So the first is the people that you lend the money to make massive trading losses and can't pay it back. Now that's very, very, very unlikely on Bybit because when you trade on Bybit and borrow assets, you actually have to put collateral on the system to pay for any potential losses. And so if losses occur for those traders, they actually should get liquidated, which means that they can't have a bad debt, which means they will always pay you back. Now, that system has worked really well for Bybit. I've never heard of any bad losses, anything happening over the many years, but it is a potential that you may have to worry about. If that does happen, Bybit do have a big fund, a security fund for that eventuality, which they would use. And that would be used to make sure that everyone gets whole. But that is a potential risk, even if it's very, very small. The other is, this is for everything, is that Bybit is a centralized platform, so you just have to trust that they're going to be around and not do anything crazy. Now, I've used Bybit for years, and I have money on here and trade on here, and they've been around through a few bear markets, and so I think that risk is extremely low, but it is potential. You have to be aware of it when using these platforms. Now we'll move on to USDe, which is a stablecoin that Bybit supports and pays some yield. So if you have stablecoins in your account, do you want to switch them from USDT or USDC into USDe? I'll explain how this works. This is from Athena. Athena is a project on the Ethereum blockchain, but they run this strategy on, I think, some centralized exchanges. This strategy is known as a delta neutral arbitrage that they're making this dollar stablecoin with. This is different to US dollar Tether, which just takes the cash, puts it in an account at Cantor Fitzgerald, buys some ultra short-term government paper. So you've got basically one-for-one backing dollar and stablecoin. This isn't that. What these guys do is carry out a fairly well-used hedge fund strategy known as delta neutral arbitrage. Sounds complex, but it's actually pretty simple. They take money and then they go and buy Ethereum and Bitcoin. So they're long Ethereum and Bitcoin. And that's not good because you have a dollar liability from you that gave them the money and this thing's going up and down in price. That's not good. So the delta neutral part is where they take a complete opposing side of the trade as well in the futures market. So they're long spot and short the exact same amount in the futures market, which means that if the price goes up, one wins and one loses. If the price goes down, one wins and one loses. But the amount of cash in the trade should be exactly the same because each side of the position nets out. So if they've got $1 billion in assets or dollars given to them, it should mean that whatever the price does, they still have $1 billion. And so that's the dollar that they can give back to you. So they have dollar liabilities to you because you have the call on the amount of dollars you gave them. Their strategy should mean that if the dollars are called back, they are able to pay them back. And the reason they pay a yield on it is because the short side of the trade in the futures market in crypto usually pays funding fees. And so they collect those funding fees and pass them back to the stablecoin. That's how it should work. Now, there are some risks here, right? Maybe they mismanage the strategy. Maybe a centralized exchange blows up or something happens. Maybe there's a huge run on the stablecoin and they can't get out of the strategy fast enough. And then there's a depeg. All of that can happen. It can happen with USDT as well, but the risk is a bit lower because no one's going to get a run on the bank because they have the dollars there, right? So there is slightly more risk here of depegging a little bit or short-term volatility of lots of people trying to get out and you want to get out at the same time, so you have to take a little bit of a drawdown. So that's kind of the risk here with USDe versus USDT or USDC, I think, although they've had them as well, right, in the past. But you get this yield on top. So if you just want to hold a stable coin with 10% yield, you can do that. So get USDe. I can switch USDT into USDe, no problem, right? And you can see the exchange rate is, more or less $1 as it should be. And so you have USDe and you're getting that 10%. Now, the other thing is that you can actually use USDe as collateral to trade with. So we'll go to Unified Trading Account and I'll search for USDe and you can see that you can use it as collateral. So if you do trade futures, you know that you put collateral on the system to trade with when you trade futures. What collateral do you want to use? Most people use USDT. Well, maybe you want to use USDe and you're actually getting 10% on top as well, whilst the collateral is in the trade and you're trading on top of that. So maybe you want to use it or not. There are some extra risks, I think, but there's also that yield. So that's an option for people using Bybit. Now we'll move to on-chain earn, which is staking crypto. So there are a couple of assets supported right now. And not every crypto is proof of stake. For example, Bitcoin isn't. And so you can't do this with Bitcoin because you can't stake Bitcoin. But most other blockchains are proof of stake, which means that it's a blockchain and it charges fees when people transact. You can buy the asset, you can stake it on the blockchain, and then a portion of those fees that users pay for using the network come back to you, a bit like a dividend from the network. And so the assets that are supported right now as making this video are ETH, Solana, and Sway. Or Sui, or however you call it. So for ETH, you can have some ETH on the platform and switch it into one of the staking assets. I think most people know how to do this now, right? So you can see the estimated APR right here. It is flexible because you can stake it and unstake it when you want. However, there is a small redeem period of a couple of days where you may not earn any yield whilst you're unstaking. But if we press stake now, and you can choose the provider. Now, Lido is the biggest staking provider for Ethereum. It's a separate company. What Bybit are doing here is they're taking your ETH and they're staking it on the blockchain with Lido. And Bybit are just passing the yield back to you. So if you can go ahead and stake this with Lido yourself on the Ethereum blockchain. You need a crypto wallet. You need to stake it there. You need to know how to do that. You need to pay gas fees on the Ethereum chain and all of that. Bybit do all of that for you. So you put your ETH and they pass the yield back. They stake it, they do all the blockchain stuff and just pass it back to you. So they're just making it easy, and you're earning right now 3.34% on your ETH, and you get staked ETH as the asset. Mantle also do this, and Mantle is Bybit's on-chain division kind of thing. So they have their own blockchain. They call it Mantle ETH, but it's the same thing. They go and stake on the blockchain, they run validators, they get some of the fees and staking rewards and pass them back to you. You can see that the APRs are pretty much almost the same. Actually, Mantle's is a little bit higher right now. Then we also have CM ETH, which is a little bit different, and you can see they have a bonus APR on that right now. Mantle, this one right here, which is CM ETH, this is a restaking asset. So we have staking on the blockchain, but there's also there's other blockchains that want to use the Ethereum blockchain, and they pay fees as well, and you can stake your ETH with them. So you're getting blockchain rewards from Ethereum, and you're getting blockchain rewards from these other networks that pay. It's known as restaking, but just think of it as earning yield from Ethereum and from these other networks that also want to pay fees. So you're staking across all of those networks as well. And at the moment, you've got a bonus APR here of 9.75%. So let's go ahead and stake now. We'll choose Lido, and you can see if you have some ETH, you can choose an amount. The minimum is 0.1. It turns it into ST ETH on the platform, which is 1 for 1. So you get 1 for 1, swap ETH into staked ETH. You're going to get 3% yearly on this, and you can stake that amount, and that just goes into your account. Now, again, with staked ETH, this will be an asset in your funding account, and the yield is just paid back to you over time in more staked ETH. So the amount of staked ETH you have should appreciate with the yield that you're getting, right? So that's how they pay the yield to you. If you want to redeem that, you can. You just go into your account, you say, I want to redeem staked ETH. Staked ETH turns back into ETH for you. Or what you can do is trade out of it. So we can go to trade, spot. I'm going to just go to this market here, and then we'll see how to trade out of it. Go to the market for staked ETH, ST ETH, should be this one here. So if you've got staked ETH, you can sell out of it for USDT, fiat currency like euros. So you can just trade out. You don't have to wait for it to redeem or anything like that. You can just trade out, get your dollars, and then you can use your dollars or euros, whatever you want, to do whatever you want with them. So that's how you trade out of it. So we'll go back to this one right here, and it's the same for Sol as well. So what we're doing with Sol, we have somewhere to stake it. You can stake on the Solana blockchain, BB Sol or Bybit Sol. This is, again, same thing. They go ahead and stake it. They give you this token that's liquid that you can buy or sell and trade. But if you have it in your account, you're earning the yield from the blockchain. So you can choose whichever one that you want to get involved with. You need some Sol initially. You can switch that Sol into BB Sol and you're getting the yield. Or if you don't want BB Sol, you can just do it directly on the blockchain, either one of these. But BB Sol is a liquid asset where you can have it in your account, earn the yield, and you can trade in and out if you want as well. Same for Sway. So what are you doing here? You're just staking, you're getting those fees from the blockchain. You can get in, you can redeem whenever you want, or just keep them in your account, and you can trade them as well if they're available on the Bybit spot market. Now we look at Bybit Wealth Management, which, as far as I know, looking at all of the documents and everything here, they're carrying out the delta neutral arbitrage strategy, the same one that I described to you that Athena was doing. Bybit run the exchange, and so they have a separate division here which buys in the spot market, sells in the futures market, and then makes a yield out of the futures funding that is paid by traders. And so what they hope to do is earn some of that yield. And so let's look at, let's say, premium. Now, if you're a VIP, you do get better rates for wealth management, I think. And you get some other benefits as well, right? Lower trading fees, better rates on loans, etc. Like I said at the start of the video. So with this, let's go over and tie up USDT for 60 days, and let's get a quote. They're quoting 6% yield on that. That's 6% annual yield not over 60 days. But you can put an amount in here, and what they will be doing is carrying out that arbitrage strategy for you. So an investment of USDT, 60 days, you get the 6% as they're carrying that out. Again, the risks are that the trade is mismanaged, centralization risk of a centralized platform. Is something going to go wrong? There is some risk here in all of that, right? So you have to figure out if the yield that you're getting is worth you tying up the money and putting it on the platform. That's up to the individual to choose. But that's how this works. From what I read, if we go down here, it says, how is the APR generated? It says they're generated using advanced trading strategies in the Bybit derivatives spot market. And that's what tells me that it's the derivatives spot delta neutral arbitrage that they're carrying out, which is the same as what Athena is doing. So again, there's some risk around this, but that's what the wealth management is. You have an amount that you put in, and then obviously you get some yield on it. I'll do some other helpful videos on DeFi and staking down in the description for you, plus the deposit bonus to Bybit. I'm James, it's MyZG. Cheers for watching, and I'll see you in the next one.